Despite the volatility and reactions that have characterized the global financial arena over the past 6 months, the outlook for medium-term returns from most asset classes remains largely unchanged and low from a historic perspective. For more, Peter Brooke, head of Macrosolutions at OMIGSA, joins us from Cape Town. Peter, before we go any further, your view on the macroeconomic environment. Surely you have some concerns given the level of uncertainty out there and, of course, the negative news flow that we're seeing unfolding across the corporate world. And I throw in here, of course, the banking sector globally. Absolutely.
I think the macro has clearly deteriorated and things are looking a lot tougher over in the last quarter. But the reality is, at the beginning of the year, we highlighted that we thought the macro was going to be bad, but the markets already knew that. That was in the price. And in fact, if you look for the first 6 months of the year, the JSE is up 9.3%. So it's really around it's what's expected. What I am saying, looking forward, is we continue to see a bad global growth environment. Our themes in terms of big government, slower global growth, are very much in play. The question is, what is in the price? And the reality is, with the changes that we've seen, is all asset classes have got a bit more expensive. And in fact, the asset class that has got a lot more expensive is in the fixed income space.
Just to ask you a question, Peter, obviously the market prices in these things, and these things come into expectations, but in terms of the integrity of the financial markets, I just wanted to ask you around this LIBOR scandal, and Bronwyn and I have just seen, looks like Bank of America is making an announcement about this. Can we have faith in the financial markets? I mean, it's one thing expecting low returns. It's another thing standing here looking at something and not knowing where one stands because everything seems to be rigged or false or fake. So can you just give us some idea as to how broad and wide this LIBOR scandal will be in terms of how it will affect the financial markets?
I think in terms of market pricing, you've got to look to each individual market and say, is it a fair and active market? So yeah, the JSE is a pretty good, pretty transparent market, and therefore the price that you're seeing gives you some degree of comfort. But the reality is, even there, so when you see a small cap share that drops 10% in one day, or you pick a high to a low, and you say, oh, that share's up 100% in the last year. No real money could have got in on that. You can't buy those shares at the bottom and sell them at the top. So there's always a degree of, you can't pick and choose exactly what happens. And I think that's just the reality of markets. As the deeper they are, the more realistic they are. What we're seeing in terms of global equity markets is we're actually seeing less genuine liquidity than we have historically. Liquidity levels are dropping across the board, and within that, we have a lot of algorithmic trading, dark pools, etc. And therefore, is that a real buyer or a real seller? It's harder to gauge.
Let's drill down now into the returns that you are expecting from both the developed equity environment and the local equity environment. And Peter, the number that I see you throwing around is 6 to 6.5% real return. Can you elaborate on that thinking?
Yeah. So when we look at returns, we always look at them in real, in other words, adding on inflation, so excluding inflation. So if you add on inflation of around, say, 5%, you're talking a nominal return of around 11%. And really returns over time are built up of your dividends and then your growth in dividends. And I think increasingly investors are really going to focus on dividends because that's what you get at the end of the day. And this quest for yield, the quest for income is going to come through very strongly. So when we look at the JSE, it's on a forward dividend yield of just over 4%. So we can grow that in real terms, call it 2 to 3%, probably just a bit below the economy because profit margins are reasonably high. And that gives you your real 6.5.
Okay, so just to interrogate that a little bit more, Peter, you also mentioned that you still expect a 6.5% real return in foreign equities as well. Yesterday we saw CalPERS come out. That's the Californian Pension Retirement Fund, one of the biggest institutional investors, and they could only post a 1% return for this last financial year. So where does that leave your thesis? I mean, if these institutions could get 6.5%, someone like CalPERS that can hire the best investment managers in the world, you know, are you maybe not being a little bit too optimistic around investors being able to receive 6.5% in offshore equities?
Okay, so first of all, what I'm talking about is these are our 5-year forward return expectations. We take a very long-term investment view at Old Mutual, and this is what we think is realistic over the next 5 years. So the 1%, I would imagine, is what they got over the last 12 months. Much like what's going to happen tomorrow, you can toss a coin, quite frankly, in terms of guessing what the market's going to do. So when you break down the international markets and say what type of returns are we going to get, in most markets around the world, we're actually seeing dividend yields greater than bond yields and greater than cash yields. And in many cases, sitting at 3 to 4%. So once again, we're at that dividend yield level. Within that, I do think you'll get a little bit of real rand depreciation over time supporting that return.
If we look at China, and I go back to Clem Sunter and his scenario planning, he's got the hard times for all scenarios sitting at around 30% probability, and the UV scenario, ultraviolet, where we will see a 2-speed recovery, emerging markets doing well and the developed world lagging. The differentiator or the kicker in terms of which scenario will unfold is China. If China holds strong, then we'll see that 2-speed recovery. If China falls and cannot sustain, then we'll see that hard times for all. And hard times for all, just to put it in the picture, is a Japan-type scenario for the whole entire world. Do you believe that China is the differentiator if I put those two scenarios to you?
So the way our macro team sees things, they have basically three scenarios. They have the base case, which is muddle through, which is low, not very attractive growth, but we don't go into a global recession. The bear case is, I think, what you call, I'm not sure what Clem Sunter calls the scenarios, but that's the bad sort of scenario. So yes, I think China, in terms of global growth, is a huge lever within that, and particularly relevant in an environment where Europe is unlikely to be contributing majorly. But I don't think it's the only factor. I think the US and the US housing market will be pretty important as well in terms of determining that global growth. So in terms of our expectations, we do see China slowing down. That's pretty obvious. But the question is it going down to 5% or is it going down to 7.5%? And at 7.5%, I think the world will muddle through.
Okay, Peter, just one of the contrarian alternate theories that have been floating around in the market regards the interest rates being set by central banks in the developed markets. People are saying that obviously in order to assist the housing market and borrowers, they've artificially lowered interest rates to their lowest record ever. Many people say that by raising interest rates so that you get real returns, you get investors enjoying real returns, you encourage savings and investment in some of these economies. That's another way of kickstarting their economies in particular. I just wanted to see what your thoughts were around these artificial rates and what policy response the central bank, like the Federal Reserve, can do at this point after it's expended a couple of its options already.
Okay, so I think that interest rates are rigged. I mean, there's absolutely no doubt about it. You're looking at roughly 80% of the purchases of bonds from both in the UK and the US have been from their central banks. So, and that's central to our world view, which is the developed world is bust. So because they're bust, they need to have very low negative real interest rates, and they will artificially get them there. So what we're seeing, we are seeing record low rates, and we're seeing it on the short end as well. There have been more than 35 interest rate cuts this year already. And I think the only way you get out of this debt problem, very simply, your debt to GDP is too high. So either you manage down your debt, which is austerity, or you try and boost GDP, which is stimulus. At a certain point, you run out of road on both of those. And I think that's the world that we're seeing, and that's because we've borrowed from the future. We've had higher growth than we should have, and now we're going to have to pay back. And that's why we see a low growth world.
Peter, just one more thing that I want to throw to you. If you look at your potential forecasts at that 6.5% real return out of the developed world and the local market, let's just focus on the developed world for a moment. Where in the developed world are you expecting that return, obviously for the longer term, as you've set out, 5 years out?
I think it's going to come more from emerging markets because that's where the growth is going to be. So if you look at, obviously you've got a degree of linkage between GDP to earnings and dividends, but internationally, emerging markets are trading at cheaper multiples. They've got pretty decent companies with reasonably high ROEs, and they've got better economic growth. So over the medium term, I would expect emerging markets to outperform developed markets. And I think it's important to highlight my key message in terms of our expected returns is that actually returns in the next decade are going to be lower than the last decade. And we're saying it's a low return world and you need to save more.